Costco wants its retail margins to remain unusually low. That sounds irrational because most retailers spend decades searching for ways to charge more, but Costco built its entire business around doing almost the opposite. In its most recently completed fiscal year, the company collected $5.323 billion in membership fees before considering the merchandise inside anyone's cart. The important question is not simply how Costco makes money. It is why earning less on the products can make the entire company more valuable. If you appreciate this type of content, gently tap that like button. Let us get into it. From the outside, Costco looks like a gigantic retail operation. Its warehouses are filled with groceries, electronics, appliances, jewelry, gasoline, and packages large enough to supply a small restaurant. The company produced almost $270 billion in merchandise sales during its most recently completed fiscal year. That number makes the annual membership fee look insignificant, but the membership is not an accessory attached to the retail business. It changes the economics of the entire building. The model began inside a converted airplane hangar in San Diego. The original Price Club served businesses that were willing to pay for access to a limited selection of merchandise at unusually low prices. Management later discovered that allowing carefully selected non-business customers into the system created even greater purchasing power. More paying members produced more sales volume. More volume strengthened negotiations with suppliers. Better purchasing economics made lower prices possible, and lower prices made the membership easier to renew. That circular relationship became the foundation of the warehouse club model. A standard Costco membership currently costs $65 in the United States. An executive membership costs $130 and includes a 2% reward on qualifying purchases, generally capped at $1,250 annually. Across its markets, Costco reported 81 million paid members and 145.2 million total cardholders. Those memberships produced $5.323 billion in annual revenue. That does not mean the entire $5.323 billion became pure profit. Costco has membership administration expenses, rewards, refunds, and the cost of supporting the wider operation. The company also does not recognize an entire annual membership payment immediately. It records a payment as deferred revenue and recognizes it gradually across the membership period. Still, the scale is extraordinary. Costco reported $10.383 billion in operating income over the same full fiscal year. Membership fee revenue was therefore equivalent to slightly more than half of operating income. That comparison does not prove that memberships generated half the profit, but it shows why the fee is strategically important. It gives Costco a recurring source of revenue that is not directly dependent on the margin earned from each package of paper towels or each television. This is where the apparent contradiction begins to make sense. Costco reported a gross margin of 11.12% on its merchandise sales. After selling almost $270 billion of merchandise, subtracting merchandise costs left approximately $30 billion in gross margin. Costco then had nearly $25 billion in selling, general, and administrative expenses. The company ultimately produced operating income equal to less than 4 cents for every dollar of merchandise sales. For many businesses, that would look dangerously thin. For Costco, it is part of the strategy. The company describes its goal as maintaining what it calls pricing authority. This does not mean the authority to raise prices whenever possible. It means convincing members that Costco consistently provides some of the best available value. The company sometimes reduces prices to drive sales, and it may hold prices steady even when its own costs increase. Costco acknowledges that these decisions can hurt its gross margin in the short term, but a higher merchandise margin could create a more dangerous long-term cost. It could weaken the reason customers pay to enter. Imagine that Costco raised prices across thousands of products and increased its merchandise profit substantially. The first financial report might look stronger. Eventually, however, members could begin questioning whether the annual fee still gives them access to meaningfully better value. Once that trust weakens, renewal rates become vulnerable. Costco would not only risk losing product sales, it could lose a recurring fee that supports the low-margin system. Low prices are therefore not merely a customer benefit. They are a form of membership protection. The next part of the machine is selection. A conventional retailer may try to offer customers dozens of versions of the same product. Costco does not. Its core warehouses carry fewer than 4,000 active stock-keeping units. Every product must compete for a limited amount of space. This restriction concentrates enormous purchasing volume into a relatively small number of products. Instead of dividing demand among 20 similar choices, Costco can direct a much larger share of its members toward a handful of options. That gives the company more negotiating power with suppliers and simplifies distribution, stocking, and handling. It also increases inventory speed. Costco says it frequently sells inventory before it is required to pay the supplier. A pallet can enter the warehouse, be sold to members, and turn into cash while the supplier's invoice is still waiting to become due. In effect, rapid turnover allows part of the operation to be financed through supplier payment terms instead of requiring Costco to fund every product for a long period from its own capital. This is not free money. Costco still owes its suppliers, and inventory mistakes can damage the system. But when merchandise moves quickly, less cash remains trapped on shelves. That improves the economics of selling goods at low margins. The warehouse itself is designed around the same logic. Merchandise often remains on pallets. Buildings are functional rather than luxurious. Limited selection reduces handling complexity. High sales volume spreads operating costs across more transactions. Each individual product can produce a relatively small margin because the system is engineered to move an enormous amount of merchandise layer. Costco says its private label products are generally priced below national brands while earning higher margins. That allows the company to protect the appearance of value without giving up margin everywhere. Kirkland also creates products that cannot be compared perfectly with an identical item at a competing retailer. If members trust the quality, the private label strengthens both economics and loyalty. Then comes the most important number in the entire story, the renewal rate. Costco reported a renewal rate of 92.3% in the United States and Canada and 89.8% worldwide. That means the membership fee behaves less like a one-time admission ticket and more like recurring revenue. Costco does not have to persuade its entire customer base to join again from nothing every year. Most members remain inside the system. The executive tier makes the relationship even stronger. Costco reported 38.7 million executive members, representing almost 48% of its paid membership base. Yet those members accounted for approximately 73.6% of worldwide net sales. That difference is crucial. The customers paying the higher membership fee are also responsible for a disproportionate share of spending. The 2% reward encourages qualifying members to direct more purchases toward Costco. More spending can create a larger reward. A larger reward makes the higher membership fee easier to justify. The member becomes more valuable to Costco. At the same time, Costco becomes more valuable to the member. The membership also changes the psychology of every purchase. A person who has already paid for access has a reason to return and recover value from that payment. Each visit creates another opportunity for Costco to reinforce the belief that the fee was worthwhile. The company does not need to maximize the profit on every item. It needs enough compelling prices to protect the member's confidence in the entire warehouse. That is why famous products, such as the inexpensive food court hot dog, can matter beyond their direct financial contribution. They become visible symbols of Costco's pricing promise. Customers may not calculate the company's gross margin, inventory turnover, or deferred membership revenue, but they can remember the price of a familiar item. Protecting that signal can be more valuable than extracting a few additional dollars from one transaction. But this model is not invincible. Costco itself warns that membership growth, executive membership penetration, and renewal rates materially influence profitability. The company also notes that members acquired through certain online promotions renew at slightly lower rates on average. If customers join for a temporary discount without developing a lasting shopping habit, the recurring revenue advantage becomes weaker. The low-margin structure also leaves limited room for error. Costco states that modest changes in merchandise costs or operating expenses can have a substantial effect on net income. A supply disruption, an inventory mistake, Higher wages or an aggressive pricing decision can quickly affect results when the margin on each sales dollar is already thin. There is also a trust problem hidden inside the model. Costco must convince members that prices remain low enough to justify the fee, while still earning enough money to operate warehouses, pay employees, invest in logistics, and expand. Push margins too high, and the membership loses meaning. Push them too low without sufficient volume and efficiency, and the retail operation becomes financially strained. That tension is the real Costco strategy. The company is not trying to lose money on merchandise. It is trying to avoid maximizing each transaction at the expense of the relationship. Low merchandise margins generate value. Perceived value supports renewals. Renewals generate recurring fee revenue. That revenue gives Costco more freedom to preserve low prices, which begins the cycle again. The $5.323 billion membership figure is therefore not a separate side business sitting beside the warehouses. It is a financial result of maintaining trust across millions of shopping decisions. Costco wants its retail margins low because a higher margin is not automatically a better business. A retailer can earn more from a customer today and quietly weaken the reason that customer returns tomorrow. Costco chose a different equation. It accepts less from many individual products so that millions of customers will continue paying for the right to buy them. And if you want to see another famous company whose real business is hidden behind the product everyone recognizes, watch my video, McDonald's Secret Business. They don't just sell burgers. You can check it out by clicking right here.